Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'll be reporting flows for the week ended March 23rd, 2016. Investors pulled about $16.4 billion out of the conventional fund business, and this is without ETFs. We'll certainly talk about ETFs as we continue on, but the headline numbers are a little bit misleading. Actually, it turns out to be almost all money market funds. We'll go through that in detail. However, as we take a look at the week that just passed us, when we're looking at the flows week, Wednesday to Wednesday, we actually had a pretty good week going. In fact, for the fifth consecutive week in a row, we actually had plus side performance for the Dow, and it actually took the Dow and the S&P 500 into positive territory for the first time this year. However, as we heard, late in the week, the flows week, we had a disaster happen where we had the bombings in Belgium. Many people were killed, a lot of people injured, and that really sent investors back on their heels to kind of evaluate what's really going on. What's happening in the Fed, what's accommodative, money policy going to be doing, negative interest rates. Those all had an impact, and people got a little sobering effect after 5 good weeks, taking a look at a disaster and something that actually put people again back on their heels and made them think twice about it, although we still had some decent flows in to talk about. Let's go ahead and take a look at the individual macro groups to see how that panned out. Equity funds saw about $1.5 billion in outflows. Considering what happened in the news and that stuff, it wasn't as big outflows as it possibly could have been. Taxable bond funds on the other side actually saw a net new money come into their coffers, about $2.8 billion. Muni bond funds continued on their merry way, $0.8 billion actually coming into the conventional fund business, $800 million. And then as we take a look at the money market funds, as I said before, about $18.7 billion in outflows. This is very normal for us at this time of the year. First of all, in March, we have our corporate tax responsibilities. Then we turn around in April 15th, and we'll have our individual tax responsibilities. So we expect to see a large amount of outflows during this time period. Let's take a look, though, how this all panned out in the equity fund arena to see what happened in that group. We saw that there was a positive return, about 0.27% return, fourth consecutive week of upside performance, but we still saw outflows, about $1.5 billion. Is the second consecutive week we've seen outflows, so it's a little bit of a head scratcher, but I think what it is people are so concerned of what's been going on in the market over the last several months that just a 5-week run really still has not convinced them that to put risk back on their portfolios. Domestic equity funds actually were the pariah of the group, losing about $2.2 billion, seventh consecutive week they've seen outflows. If we take a look at the non-domestic equity funds, they also saw outflows. They saw inflows, about $668 million. So not a lot coming into their group, but again, positive side, 7th week and 8th that they've seen positive flows into their group, and this has been a trend we've been seeing for quite some time. People shunning the local equity funds, taking on more risk, going on to the global overseas funds, and it certainly was the case this time. How it broke out, if we looked at the particular group, large cap funds actually saw about $2 billion of outflows. Real estate funds saw about $139 million in outflows, so not a lot. Again, it wasn't a big story. Global equity funds, ironically, actually took in the biggest flows, about $890 million, and international equity funds saw outflows, about $222 million. So investors were they were hedging their bets, let's say, because they were doing a little bit on the U.S. side by going global. They actually got some international and some U.S. focus on there, so we did see that. Let's take a look now, though, at what's stacked up in equity funds, because this was quite a different story to talk about. We took equity funds, fourth consecutive week, $3.5 billion in net inflows. At the top of the group, we saw the iShares MSCI Emerging Market Fund actually take in $2.8 billion. iShare Russell 2000. So these are kind of if you will, unconventional things to invest into during a concerning time period. But anyways, Russell 2000 saw about $1.2 billion in net inflows. And if we look at the bottom, we take a look, SPY actually saw the biggest outflows, $1.1 billion, and then PowerShares Q Trust saw the next largest outflows, a little under $800 million in outflows. So certainly it was one of those stories that people were actually bottom shopping, taking opportunity when they saw the dip in the market. That could bode well for continuing runs as we go out through the summer and the like. Let's take a look at our fixed income universe to see what happened in that group. Fifth consecutive week, we've seen inflows, about $2.8 billion this time. Sixth consecutive week, we've seen plus side performance, this time to the tune of 0.42%. Remember, this is on a week-to-week basis, Wednesday to Wednesday, so 0.2% is actually pretty robust. If we take a look, though, we saw the big winner, balanced funds. I usually don't report balanced funds in the mixed asset group or in the fixed income group, but underneath the AMG, old AMG moniker, balanced funds actually are in there because they've got, again, about half in fixed income securities. So they saw the largest inflows, about $1.1 billion. Next group, risk on, high yield actually saw the next biggest inflows, about $600 million into that group, while treasuries were the only group to see outflows, about $124 million. So that tells you that people were actually walking away, at least on the fixed income side, from that risk-averse type of investing back to a risk-on portfolio. Let's take a look at see what ETF investors did, the authorized participants. Authorized participants actually put about $3.1 billion back to work into the ETF universe. 11th consecutive week that we've seen inflows into this group. iShares, iBox, high yield, also a popular group to invest into. About $100 million. About $1 billion in net inflows. And the iShares 20-plus Treasury bond also saw inflows, about $597 million of net inflows. If we look at the bottom, though, people got rid of those short areas. So 1 to 3 Treasury bond lost about $600 million or so as far as net outflows go. So it was one of those stories that we did see fixed income investors actually putting risk on, going after yield, and it certainly stayed true in both the ETF and conventional fund business. Now let's take our attention to muni bond funds. They've done a great job. $815 million of net new money coming into the group. 25th consecutive week they've had money coming in. It's the first week in 6 that they've had positive returns, 0.21%. And if we take a look at the National Muni Group, they took about $686 million of that 815 in. And that's been the trend we've been seeing. So single state did take in a little bit of money, and of course, as we're looking at the tax time coming around, it does make sense that people are actually looking at buying opportunities in the municipal bond area. Well, that would bring us to our next point, and that's going to money market funds. And as I said before, we saw a big outflow, $18.7 billion, saw second consecutive week of big outflows. Last week we saw some big numbers as well. And how this broke out, and we do attribute this mainly to tax and end-of-year type of transitions, but how this broke out is we saw the taxable money market funds lose about $14.8 billion, and if we broke that into institutional and retail investors pulled out 13.9, and those are institutional accounts now. It doesn't necessarily mean that the institutional investor, it could be you and me in our 401ks making moves and such. So 13.9 coming out of institutional type of funds, and then we saw about $900 million of outflows on the retail side, and at the very bottom, tax-exempt money market funds saw about $3.9 billion come out of their coffers. So investors obviously parking it on the side for those tax-exempt purposes, but maybe putting them back to work in the upper part in the munis, and then maybe taking a little bit out to spend for themselves. Well, that brings us to the end, and certainly as I take a look at the numbers and watching the news that are on, obviously the concerns about continued retaliation by the ISIL and a few other groups, for taking out their top leaders and arresting some of those criminals that bombed France. Certainly we're concerned about that. As we take a look at it, though, we didn't think that a lot was going to happen for the Easter shortened week. Certainly we're taking a look at what's going on. Durable good orders actually came in a little bit lower in February, so that may be a little bit of a downer on the group, and certainly may cause a little bit of outflows and people to rethink what's going on. Soft economic news coming in this week, so we'll have to keep an eye on what's going on. Certainly, all eyes will be on how Belgium recovers, if there's been any more terrorist attacks and the like. Well, that's it for me, but if you want to do a deeper dive into areas that you think are important, you can go to our site at www.lipperusfundflows.com. If not, meet us next week when one of our analysts will talk about flows for that particular week. Until next time, my name is Tom Rosine, wishing you the best in your wealth planning and creation.